All right, let's go ahead and get started. Thank you very much for being here today. My name's Carl Baker, the Managing Director of Baker CFO Advisory. For those of you who are live, we appreciate you spending the time with us this morning. We'll obviously record this, and this podcast will be available along with our entire series of podcasts in which we are talking about issues that we think are germane to business owners and organizations. I know they're germane because I talk to clients every day about various topics, and we don't talk about things we don't have a skill set in. So that's what we do. So look back at our YouTube videos, and you'll see several webcasts that we're putting out there to help businesses. Who is Baker CFO Advisory? I wanted to spend just a couple seconds on that. We're an accounting firm. Some people might look at our firm name CFO and say, "Oh, well, we don't need that." We're an accounting, fractional CFO and consulting firm helping growing businesses with their accounting, their operations, their tax needs in multiple ways. We serve nonprofits, we serve healthcare enterprises, physicians, dentists. We serve professional service firms, we serve contractors, and a number of other types of organizations. Essentially, if you're a growing business, we are able, in one of those categories, we're more than likely able to help you. Just wanted to throw that out there. BakerCFOadvisory.com is our website. You've found us already, so you've probably seen that, but just wanted to comment on that and introduce ourselves briefly. Wanted to take a moment. Yes, I'm going to be that guy. If you watch any other YouTube videos, you'll see that people always ask you to hit the like button if you like this series, if you like the session. Subscribe to our YouTube page. It helps build a following, and it helps tell YouTube that a following is being built. So would appreciate doing that. And as long as we're meeting the needs of people, and as long as we continue to grow our following, we'll continue to do this. I love educating and talking to people about strategy issues, etc. So just wanted to bring that up. Again, thanks for being here. Also, I've said it before, but thanks to my assistant, Erica, who's listening here. She is the behind the scenes machine that keeps these things running, keeps me on time, keeps this process organized, and puts out the messaging. So just wanted to say thank you to Erica for that. All right. So we are here to talk, and but before I forget, it's in the last slide, but who knows, you might stop listening by then. I would just want to tell you our next session is, it's always the third Thursday of the month, and we're going to talk, we work with growing businesses, and some of those businesses are super growing, they're well established, some of them are more in the startup phase. I wanted to talk next month to those business owners that are solo entrepreneurs, sole owners, and they're growing, they're scratching their heads, trying to figure out how to grow. And you don't have to grow as a sole business owner. Many business owners are happy with where they are. They're earning the living they want to make, and they're happy with that. A-okay, no problem, fantastic. There are a lot of business owners, though, that want to grow. They're at the $200,000-$300,000 mark, and they're trying to get to $1 million. Then they're trying to get to 2 million. Then they're trying to get to 5 million. What does that look like? What does it take to get from $500,000 to $2 million? I can promise you, running a startup business is different than running a $10 million business. The things involved are very different. So we're going to talk about that next month. This month, though, if you're following the news, there's lots of discussion. Are we in a recession? Are we going to be in a recession? Are we headed for a recession? There's lots of discussions about interest rates, about with my healthcare clients, there's discussion about what the government might do to reimbursement, compressing reimbursement, delaying payments, etc. So that could trigger issues within organizations. Tariffs, if an organization relies in any fashion on international importing, that could impact your cost structure. It could impact your clientele, business, all those things, obviously your pricing. So there's lots of discussions, and obviously we're not here to talk about politics and opinions on all those things, but I just wanted to spend a moment, a session today to talk about what would you do? What would I do? What would a business owner do to evaluate the financial implications to a pending recession? I don't know if we're going to go into a recession or not. If we're in a recession, historically, the facts are that we end up being in a recession for 6 to 12 months before the government officially announces, yes, we're in a recession. I don't know. But the reality is interest rates are higher than they were several years ago. There are economic pressures. There are lending. The lending environment is a bit tight right now. So there are pressures. So I just wanted to spend this session today talking about what would you do, what would I do if you wanted to do some scenario planning, if you wanted to evaluate your business from a protection perspective, if there is any sort of a turn down. And by the way, there could be a macro turn down. There could also be an industry uh, issue. So this topic really is germane to anybody that might be in a situation where there are pressures within your economic community. So that's another reason to talk about that. We're going to briefly, before I start to move to the next slides, we're going to talk about uh, your services and products. Are they recession proof? Are they susceptible to turn downs? Then we're going to talk about how to evaluate your business from a revenue perspective, from a access to capital perspective, from an expense structure perspective, from a process perspective. Some businesses will say we're gonna pause on our growth initiatives, maybe not, but we're going to pause on our growth initiatives, and we're just going to make sure that what we do well, and we're going to put processes in place that will strengthen our system for when it's time to turn the rockets back on. And that's an approach. So we'll talk about that a little bit, and then we'll maybe certainly I want to encourage anybody listening to ask questions. I think our chat feature is on. We have some pre-prepared questions to elaborate on a few things that will probably sprinkle into this. With that, I'd say let's get going. Thanks for being here again. All right. So, what does it mean to recession proof your business? eh, Recession proofing is not about panic. There is inevitably, if you've been in business long enough, and I've been in business for 33 years in one fashion or another, and graduated from college 33 years ago this month. So I've seen many, whether they are industry ups and downs or macro country ups and downs. Inevitably, there are going to be those things, those volatile situations. No reason to panic. We always get through them. Certainly, it does require a response. So that's what we want to talk about. And the key word here is preparation, and just being prepared to understand how to react to what's happening in the market. Obviously, we're in the business to meet a need, to serve a community, to provide jobs to our employees, to meet, to solve problems in the community. So that's why we're here and why we do what we do. And even in a downturn, it's a matter of making sure that can continue to be done. Because if you think about it, a recession typically very well might mean that those problems that you're solving are going to only increase. They're only going to become more acute. So just another few opening comments around that. So let's start off with what is our biggest vulnerability if revenue were to slow by, let's say, 20%. What would happen? And then as I was preparing for this, I thought, well, why would revenue slow? Why would revenue slow? Obviously, consumer issues, consumers, your clientele, your customer base might have less money in their pocket. Maybe their problems are already solved. Maybe demand goes down. But again, why is that? I think it's important to understand where you fit in the recession-proof spectrum in terms of your service. Maybe it's that your service or product is a little more susceptible, vulnerable to a recession. And as I was preparing for this is totally goofy, but I think of something like the pet rock, and I have no idea why I thought of that, except that I would assume if the company that is producing pet rocks, I'm assuming when tourism goes down, the sales of pet rocks in these tourism stores are going to go down. Maybe not, because they're only a couple bucks, and the decision making process that goes into whether you spend the money on that in a moment, on a lark or not, may not really be impacted by recession proof. But I'm trying to make a point, on an extreme basis. There are certain products or services that might be more susceptible. We learned a lot during the last 5 years with COVID, where we thought industries that were susceptible to to a recession maybe aren't as susceptible. For example, we thought that with the recession, the COVID, the shutdowns 5 years ago, that real estate would go into a recession, that there would be a valley there. What turned out was that real estate actually went through the roof. We had a favorable interest rate environment. People were staying home, so instead of going on vacation, they were spending money on refurbishing their homes, putting in swimming pools, refurbishing decks, all those things. So things that we thought were recession susceptible ended up not being, and I'm assuming things that we maybe thought weren't recession vulnerable ended up being. So restaurants tend to have a downturn in certain aspects, but if people don't have money, the disposable income might shut off, and people might start eating out less. So those kind of things, just be aware of that, and then evaluate and understand whether that means you should shore that up by diversifying your product offerings, your service offerings, to mitigate that risk. Just wanted to throw that out there because I think that's very important to understand in your service. But then let's drill into actual revenues. And what would happen? We've set all that aside. We understand what the risks are from a service and good perspective. What happens if we think that we are susceptible to a downturn, and we are wanting to understand what that would look like? So we're going to recommend a situation where you do some planning. And one of the things that I talk about with clients all the time, it comes up routinely, and that is the difference between cash flow and the profit and loss situation. The amount of cash you have, the amount of cash reserves you have, the amount of cash flow you have, doesn't necessarily mean that there is profit or loss. Certainly on a long-term basis, if you're not profitable, the cash flow will slow down, and certainly your reserves will dwindle. But we start with, what is our reserves, what is our cash flow, and how long can we operate if our revenues go down, hence our margins go down, and our cash reserves start to be tapped into. So what we recommend is doing a form of budgeting in which we do some scenario planning. And I've put in here understanding what our cash reserves are, what our burn rate is, what our use of cash is, and then model those scenarios out. And it could be as complicated or as simple as you want, but we recommend a 3 scenario set of options, or set of what's the right word I'm thinking of? Scenarios. I'll just stick with that. So a baseline. What do our operations look like on a baseline perspective? Then what happens if we have a dip? What happens if our sales plummet and understanding what that mean. You might be able to function for a year if you have the appropriate amount of cash or access to capital. You might be able to function for a year with a 50% dip in your business. Maybe, maybe not. You probably don't want to, but understanding how long can you function with a 20% dip or what I'm calling a plummet in your operations. So just know what it takes to stay solvent. And if for those of you out there, you understand access to cash and the cliche cash is king, those are overused cliches, but they really are real. If you have profit but you're not collecting on that cash, then it's going to be very difficult to manage that process. So we talk about that, and we actually put in our email distribution list, and we'll have in our chat group, our chat link here, a link to, and it will eventually be on our website, our free white paper. We have a series of white papers that I think are fantastic. We put them together, review them, make sure they're appropriate. This one is how to walk through the 3 different scenarios. And by the way, I'll also say I'm hoping this will trigger some conversations. I am always willing to have a conversation with somebody. Maybe you want to hire us, maybe you don't, no problem. I'm just here to help. Certainly always willing to have a conversation. And if I can help you get started, you want to run these scenarios and do those things, happy to help you get started with that. So call, happy to help. Download our free guide. It'll give you some tips on that. So just an FYI there. Moving on, we've talked about our service, we've talked about revenues, and I can't stress this enough. Access to capital in one way or another. Again, this comes up with business owners all the time. People say, I don't want debt. If I need debt, I know how to get it. I'll get it when I need it. We don't want to borrow. We're anti-borrowing. And I'll just tell you, I think there is a accessing capital is a foundational exercise, and it's certainly what that capital instrument looks like is different depending on where you are in your own business life cycle, depending on the type of business you are, depending on your relationship with banks. But honestly, it really boils down to where you are in your business cycle, what your financial position looks like. And so I put some notes in here. I think it's a foundational exercise to seek access to capital in one way or another, especially in the form of lines of credit, before you need it, and to seek more than what you think you need before you need it. If you end up in a downturn and you go to a lender and ask for a loan, they're going to say, well, why do you need a loan? What is your capital needs? What do your revenues look like? And if you are showing them, and because they will ask, what do your financial statements look like in the last 2 or 3 months? And they'll see the downturn. Their first question is going to be, why would we give you money if you're in a downturn? So they certainly want to help, but they're renting money to you. And I've said this before, if you were watching our series, they're renting money to you, but they want it back. And their end goal is to put mitigation in place to make sure, I'll say it again, to make sure they get the money back. And so they're renting that to you. And if you're going to a bank when you're struggling, it's going to be more difficult. A bank or another lender, there are certainly non-bank lenders, but if you're going to a lender and asking for access to working capital funding when you're struggling, it's going to be a different conversation. It's going to be more expensive if you qualify at all than it is if you are seeking access to capital as a safety net before you need it. So let's just keep going on this. Hop on a soapbox. I feel really strongly about it. I talk with every client about that. And there's a lot of misnomers. And I think that we can really help you see that if we have an extended conversation. So what do? You want to update your financial statements. You want to make sure that your financial reporting packages are accurate. Understand your numbers. Understand your debt service coverage ratio, which is the calculation that tells a lender your ability to pay back financing. So understand that, understand your margins, understand your existing cash runway. So I just think it's important to talk to lenders, seek the working capital. And I'll throw out for any of our listeners that are small business and I talk with business owners all the time about accessing, as an entry point, accessing business lines of credit, i.e. in the form of credit cards. Somebody says, well, I don't want a credit card. Well, credit card is the introductory way that banks will establish a relationship with you and give you a line of credit. The credit card is actually a piece of plastic to give you purchasing power, but the line of credit that they're giving you is the way you can build a relationship with lenders and demonstrate your ability to manage your debt effectively in where you are in that place and time. So I talk to clients all the time about that. So last line there, talk to lenders now. If you don't hear that, I do spend some time on that because I think this is very important. It's one of the most important things I think a business owner can do to ready themselves for any changes in their business. All right, let's move to the next section, which is expenses, reducing expenses without cutting capacity. What is we've talked about revenues, we've talked about service, we've talked about capital. So the next item is expenses. What is a way to reduce expenses without cutting your ability to actually serve your clients? Well, it is inevitable. I've worked with enough clients to know that that there are going to be things in your cost structure that you could probably live without, either on a permanent basis or on a temporary basis, as you're navigating through a cash burn season. What does that mean? Maybe it means living with some less software. I've seen that. Maybe it means going to some of your contracts, your vendors, and saying, can we change our terms? Can we take a little longer to pay you? Can we skinny our contract by 3%? Maybe it means we pay you faster for a discount. There are things, and there's not a magic set of lists of things that I know every business should be cutting out, office supplies or whatever. There's not a magic list, but I've worked with enough businesses to be able to tell you that when you are critically looking at your financial statements from an operations standpoint, from an objective standpoint, from a fresh viewpoint, you will find things that could be cut out when you're trying to hit a goal. So you might, through the scenario planning, you're going to identify a delta, a number that you need to cut out of your structure. Hopefully you can do that through increased revenues, but the whole point of this is we're dealing with decreased revenues. So what sort of variation can we put into our expense structure? By doing that, you'll also probably have a better understanding of what your fixed cost structure is versus what your variable cost structure is. And we talk about this all the time. I was talking to a client just yesterday about the potential investing in some revenue producing people. And the comment was, well, that'll just add to the budget. And that's not necessarily the case. If it's a revenue producing person, then as long as there is a good plan in that hiring process, you're actually investing in the business and investing in future margin, because you're paying that person, but that person will then generate revenue. Hopefully the revenue will be more than the expense. And so who cares about the budget impact as long as the budget impact on the expense, as long as there is a good plan that is able to be executed such that the person will generate revenue to add margin and add cash flows. So understanding those variable costs, whether they will produce a direct dollar for dollar return, and whether they will produce some sort of an ROI from a dollar perspective or some sort of a value perspective, and just one of my points in here is to do this as quickly as possible. Recognize this is where you are and respond and react as quickly as possible. My other point in here is sometimes an across the board cut does work. I've seen it. It's usually a component of a set of actions that are being taken. We put the magnifying glass on certain areas of the business, skinny up what we can, and then do some sort of an across the board. I've seen that plenty of times, but certainly we want to do that on a strategic way, and not necessarily the first thing to be done because of the impact to the business. I'm going to stop here and say we do have a question to go back to. What is a rule of thumb for cash reserves? And I didn't really talk about that. It's a great question. People ask all the time, and I'll throw out the answer. It depends. Love that answer, right? I say that mostly as a joke, but um, think about if you have you know what your expenses are. We talk in terms of cash reserves. We talk in terms of days cash on hand. How much are you spending on a daily basis? And that's on an average, on a weekly or monthly basis. How much are you spending? And how many days worth of cash do you have on hand? Is 2 days enough? Probably not. 5 days? Probably not. It's certainly not going to give you any reserves for a turndown. Uh, I'm going to say rule of thumb, to mitigate some risk of turndown, you probably need to be looking at somewhere in the 30-day range. Um, 15, 30, and if you're in the 5 day range, don't panic. Just put a plan in place. I'm working with clients right now in that situation. We're putting a plan in place. You may not be able to get there today, but put a plan in place and build your reserves. The only way you build your reserves is you maintain profitability and you keep the cash in the bank to help with future needs. But rule of thumb, it's going to be different for every business, but I'm just going to stay, if you need a number, I'm going to stay with 30. All right, enough on expenses. Let's move to pricing and profitability, which is really the end result of revenues, expenses, protecting your margins. The only way you're going to build cash is if you protect your margins. If your expenses are more than your revenues, you can handle that depending on your cash reserves or your access to working capital. You can handle that on a X number of days, weeks, months basis, but you have to eventually get back to a positive margin situation in order to build up those reserves. Invest in people, invest in raises for your people, invest in your physical operations, technology, if you're real estate heavy, real estate, etc. So protecting your margins, what does that mean? That means going back to your expenses, evaluating your expenses, but it also might mean, in this slide, it also might mean understanding that your customer base, your client base doesn't, they might not respond as negatively as you tend to think about price increases. Certainly some will, and you will know in your business what that is. But my guess is, and my point in bringing all of this up is, you probably can increase your prices depending on if you have price control, and sometimes you don't. My healthcare clients don't have as much price control as they'd like because of third-party payers. But if you do have price control, to the extent that you can, you will want to eventually ask your clients to pay more, your customers to pay more. For those clients, for those organizations that don't have price control, pricing power, then I think you'll probably want to just make sure that your processes are as favorable to you as possible. And I can think of situations where you don't, in my healthcare enterprises, you don't have price control, but many of your patients require, are required to pay a copay or a deductible. getting that up front, shoring up those policies up front, might be a way and might be the best thing that you can do to improve your cash flows and to protect your margins. Because once the patient walks out the door, the likelihood of collecting that cash is less. So that's just an example. But protecting that margin will help you get back to your cash reserve building. All right, continuing on with this next slide, revisiting revenue models and customer concentration. And this really harkens back to my early comment about whether your goods and services are susceptible to macroeconomic pressures, microeconomic pressures, industry economic pressures, specific clientele economic pressures. It is a truth, and this is an extreme example, but we in the accounting industry, we focus on this. This is actually this gets really wonky, but this is a required disclosure in financial statements. If you have a full set of financial statements that are built in accordance with accounting principles, there's actually a required disclosure to tell the reader of your financial statements what your reliance on a concentration of customer base is. So if 70% of your business comes from one customer, then that is a major risk. And in the full financial statement world, that's something that has to be required. But that's wonky. It's a real thing for businesses that have real financial statements, but you should understand, and you do intuitively, but understand the risks of what that means to your business if that one customer then walks out the door. I have another client that has recently told me that they are working on accessing capital, improving their service model, improving their list of services. Why? Because they were relying on one client that has temporarily walked, and so they're navigating through these very issues as we talk about them right now. So understanding that, and then understanding what to do about that might mean an improved marketing and sales process. It might mean adding new services. It might mean asking that customer to give some referrals to other clients, but somehow, some way, mitigating that risk eventually will be the best thing to do. All right, so my last slide, if I remember correctly, is regarding things to do, is to evaluate your own processes and internal controls. I will tell you, some businesses that are seeking to grow, they're either seeking to grow with good processes in place or not good processes in place, but they've made a decision to move on, and they'll eventually have implications there if their processes aren't in place. But some businesses say, you know what, we're going to focus on doing what we do very well. We're not necessarily seeking to grow at a 20% clip this year like we've been doing in prior years. We're just going to make sure that we do really well with our clientele, with our customer base. We're going to shore up our policies, use this slowdown to shore up our stuff, shore up our financial reporting, shore up our processes. And that's not necessarily just in the accounting space, the finance office, but your sales processes, your marketing processes, your HR processes, your hiring processes. So this slide really is talking about the accounting processes, but I can't emphasize enough that this is a holistic discussion that carries across the entire organization. But with that in mind, what are the other points on this slide? Tighten your controls. Oh, that's a good one. If you have a set of processes in which people are buying things for the good of the company, and you have some purchasing protocols, now is a good time to evaluate whether those limits that you have in place are right. You might tell some of your mid-level managers, go out, buy whatever you need. You have authority to buy whatever you need at $1,000. Anything above $1,000 comes to me, comes to the next level, whatever. Now is the time to evaluate, is the $1,000 right? Should it be 500, just to make sure that there is a second set of eyes? Maybe, maybe not. I'm not saying, I'm not using those numbers as hard numbers. I'm using those as examples. They are very real numbers for many businesses, $1,000, 2,500, whatever. But evaluating those levels to understand whether you could use that process to evaluate and understand better where you're spending your money. And the second set of eyes, I promise you, will produce results and produce questions if done critically. What are other comments? Reviewing your KPIs, especially well, we've talked about all these other things, but your monthly reporting packages, your collections, your accounts receivable, aging, understanding whether you can whether you're collecting on a timely basis or not. So those are things just to shore up, and now might be the time to do that. All right. So from a CPA perspective, we'll see. We do have another question here. I think just to be honest, this is a live session. It's live. So she's telling me that there was an issue with the chatting, but I see the issue here, or see it come up. So what financial reports or KPIs, key performance indicators, should we be reviewing more often during an uncertain market? Well, we talked about a few of them in this slide, but it sort of depends on your business. But I'm going to say off the top of my head, what ability do you have to stretch out your payables? What is your daily cash? I know in certain situations where cash is an issue, looking at your daily cash is important. Projecting out your cash flow on a daily, weekly basis is important. I have clients that are doing that right now. And we're helping them with that. So understanding your cash flow, your projected cash flow, I think that's important. Your margins, are your margins slipping? If you happen to be in a business that has a lot of inventory, managing your inventory in an effective way is very important. Many organizations in a situation such as a downturn might reduce their overall inventory, because if you think about inventory means you're spending money to put product on the shelf to sell later. And so that is a huge investment in cash. And so if you can function with less inventory on hand, to the extent possible, with a better inventory management system, keeping in mind you obviously don't want to have no inventory that can't satisfy the needs of your clients, but managing that process is a skill set. And so I'll throw those few things out there. All right, so the CFO perspective on recession planning. What are some of the things that you as a business owner, with your existing CFO, with a fractional CFO such as us, with a fractional CFO such as somebody else, with your own permanent CFO, one way or another, what are things that the financial leadership of the organization, and again, you might be a solo entrepreneur wearing all the hats. What is it that you can do when you're wearing your CFO hat? What is it that you can do? Well, we say in here, the earlier you forecast, keeping in mind the things we've talked about today, the earlier you do that, the better you will have data in order to respond, as long as you're willing to respond to that data and do what you need to do to protect your business. Sometimes we talk about what, and I've even alluded to it today. Should we delay growth plans or double down? And we talked about those companies that want to delay growth and just make sure that they are good at what they do by shoring up their processes. That's an option. Some people will say the downturn is an opportunity to shine, and that's a very real thing. Some businesses aren't prepared, and they won't be able to respond to their clientele, and they won't be able, because they don't have the cash reserves on hand in order to continue carrying out their operations. If you're protected, if you are ready, then you might be a last man standing, so to speak, that are able to grab market share. And understanding that and understanding the implications of that future issue now is the key to evaluating. I personally don't know on a broad basis, should you double down or should you delay your growth? It's a business situation, but that's the way you're going to evaluate that. Yeah, a few other points there. Certainly, I have heard over my years, and I've talked to clients about it. If you're not growing, you're dying. Certainly, if you don't have new business coming in, it is a truth that eventually a business that isn't seeking to get new clients in one way or another will eventually die, because inevitably, no matter how good you are, businesses change and your customer base will change. That means they will contract. A business, though you might be the best service provider or goods provider, a business might, for whatever reason, leave you as a service or goods provider. So you always have to be working on that. That's not profound. You know that if you're a business owner, but being aware of that is another thing to keep in mind as you're evaluating your opportunities. But you can't double down and grow if you're not protected, if you're not ready for that. So that's really why we're talking about it today. And then I'll throw out, if any of you follow me on social media, I've mentioned as recently as this week, my hockey interests. So there is a term when you're learning how to ice skate, when you're learning how to play hockey, there's a term, a notion in the lessons about keeping your feet moving. If you watch a hockey game, the professionals are almost always keeping their feet moving. They're always skating. They're not just going down the ice with their two skates stagnant, gliding down the ice. If they are, they're doing it for a purpose, for a reason, and they're at the ready to move at any moment's notice. Or maybe they're, getting ready, set up for a misdirection play or something. But generally, keeping your feet moving will help you keep your business going. So that's another comment. Reiterate again, we're coming to the end of our session. Look for our download in the chat feature in the chat section of this website. We'll put it on our social media. We'll eventually put it out to our distribution list. Yes, you probably will have to give us an email address. Hey, if you don't want to continue receiving our materials, unsubscribe later. But we're certainly trying to provide materials that adds value to help you run your business, give you some nuggets. We're well aware you're not going to spend 5 hours probably reading every word of a document like this, but you're going to get some nuggets. I do the same thing with people that I follow. So we're trying to give people nuggets and information that will help you run your business. So download that free guide. All right, my contact information is here. If you have questions, put a comment in our YouTube page, find me on social media, reach out to my email address, carl@bakercfoadvisory.com. Our website is the same thing, bakercfoadvisory.com. There's an info email there in which you can contact us. There's a phone number there. Here is the announcement for next month's presentation. What got you here won't get you there. A roadmap for scaling business for solo operators to structure and grow your ready companies. Let's see how to end this. I'll just say these are very real issues. I could tell you a number of client stories where in one fashion or another, we're navigating through these things. And I would just say it might be, and it might be on a magnifying glass in one place or another. It might be to really look at our cash reserves. It might be to evaluate processes. It might be to look at expense structure. It doesn't have to be all of those things. But in one way or another, businesses that are vibrant are planning to remain vibrant or to become more vibrant by navigating through this process. So I'll end with that and say thank you for joining. this month. Look at our past materials. Stay tuned for future webinars, and we really appreciate you taking the time to watch this, whether it's live or in the recording. We appreciate it, and thanks very much. Bye-bye.